해보는데 In progress. Won't be able to move your money. You need to be able to earn more than inflation, and stock market is that place that can earn more than inflation rates, right? Now, why is it so? Why is the stock market able to, it's kind of a hedge against inflation because it's able to earn more than inflation. What you're really doing in stock market is you're putting your money in businesses, right? And businesses will grow as much as the economy grows. Some of them will outgrow the economy and grow faster. That's where you can make more money. And that growth in the economy, you should also add inflation in it. So if you look at a normal business in India, it grow as per the GDP of India, which is around 6-7%, and you add another 6% or so in of inflation. Because businesses, if price goes up, let's say, if the raw material that the business uses, the price goes up for that raw material, who will ultimately pay the price for it? Is it the business? Will the business be taking that cost on itself? No, it will just pass it on to the customer. It's the customer will bear the brunt of it. So if the price goes up because of inflation, it does not really impact businesses as much as it does to the end user, right? So you can say if you invest your money in stock market, which is in a way invest into different businesses, you get a kind of machine against inflation. Your money will be able to grow more than inflation. And typically, if you look at this equation here, that if GDP is growing around 6-7%, right? It's a 6% or so. And if we assume that inflation is also around 6.5%, right? Maybe 6, maybe 7%, then we're talking about total growth of roughly around 12%. So if you are investing in stock market, the minimum expectation that you should have is somewhere around this much only, maybe 11-12% is something that you should be able to get from the stock market because that's what the GDP growth is. And you add inflation to it, that is the number that you get around 12%. So if inflation is 6 and you're earning 12, in any case, you'll be able to build your wealth. You do few more things right, you should be able to get about 15-18% kind of a return. And you do it over a long period of time, you'll be able to build wealth for yourself. How much time does it take you? Well, look at this for an example here. This stock that we're looking at, let's say it is Pent. Yeah, this is an indicator that I use, and it's called the Ultimate Plus. It is something that I have designed. Right now, the moment the price goes above it, it is a signal to buy. So that we share it with you, and right, if we just really see it down here. So the moment the price goes above the line, it's a signal to buy, and when it goes below it, exit, right? For our exit restrict, right? So here, when you see this, we are talking about 12%. Look at this. In May 2023, that means roughly 2 years ago, the price here was around 1600 and was the high that it made. The high that it made was around 8200, right? So even if you, let's say, it was around 2000 and it touched a high of 8000, we are talking about 4 times return, right? 4 times. If you're earning 15% return, right? Let's say if you're earning 15% return, how much time will it take you to earn that 4x? So this stock in about 2 years went up by 4 times, 4x. How much time does it take you? Is it going to take you to get 4x if you're earning 15% return? Can you take a guess, right? Whatever that comes to your mind. If you if your investment that is earning, is earning about 15% return a year, how much time will it take you to get to 4x? That means 10 lakh became 40 lakhs. In this stock, it became 4x in 2 years. How much time do you think, if you were getting about 15% return, how much time will it take you? Yeah, any guesses? How many number of years will it take? Yeah. How many number of years? What do you think? Any idea? Any calculation that you can do right now? I'll tell you in case if you do not know this. It will take roughly about 10 years for you to get to 4x. Right? So let's calculate this, okay? So let me share it with you. I'll share my Excel sheet. Okay, let's just calculate this. Okay, let's have a look. Okay. I hope you're able to see this. Yeah. So let's say if you okay, so let's say if you are getting so let's say if you are getting about 15% return, that's 1.15. If you're getting about 15% return, um, you'll be able to see that. So if you're getting about 15% return and you get it for 10 years, what will happen? This raised to the power of 10. Your money will grow by 4x. But in that stock, the stock that we were looking at, this happened in just 2 years, right? Instead of 10 years, it happened in 2 years, right? And we all would love to have something like this, right? But in stock market, if this is the kind of expectation that you come with, most likely you will lose money. And if you have an expectation that if I can get about 14-15% return, even if I get 4x return in 10 years, I'll be fine. You know what will happen? Probably be able to achieve it in 5-6 years. Right? But if you come to the stock market thinking that I want to make a lot of money, but I want to do this quickly, most likely you lose money. But if you come here with the intention that I want to make a lot of money here, but I'm in no hurry at that time horizon of 10 years or so, you'll see wonderful things will happen with you because you'll wait for opportunities. And you'll be able to find plenty of opportunities in the stock market. It's not that you have to chase the opportunity. You have to be patient to get opportunities, right? So let's find out which kind of stocks that we can invest in, right? So when we talk about businesses, what is the number one objective that any company has? What is the purpose of running a business? What do you think? What is the purpose? If you start a business today, what is your ultimate objective? Is to okay, so we are very yeah. So we are here to get people, but the number one objective is if you're starting something, yeah, of course, we want to help maybe solve a problem. But at the end of the day, if you're not making money, you won't be able to help people, right? No matter what intentions you have, how good your intentions are, if the business is not making money, that intention alone will not be able to see it through, right? So we want profit at the end of the day, right? So when you're talking about businesses, we want the business to be profitable. So when you're looking to invest in a company, you should be looking to see if that business is making money or not, right? And it's really simple. You don't have to complicate the stock market thinking this has too many moving parts and what do I look what things do I look at? Have to analyze so many things, spend hours and hours. You don't need to, right? You just need to ensure that the business is making money. If it's not making money, then we won't be looking to invest in it. And it's not just making money once. We want this business to be profitable, and this profit should be growing. Right? We practically be looking at few things as well. Second thing that we also want is where is this profit coming from? This profit is coming from revenue. Okay. What is revenue? Sales. So we want sales and the sales to grow. So it's not that it's doing the same sales over and over, the same amount every year. We want the sales to grow too. Okay? Even for any business, we want the sales to grow as well. Yeah. And what we also are looking for is we are looking for the earnings to grow as well. So that's the thing that we want the profitable company to be. A company which is making money. If it's making losses, we will not invest in it. Then we want to see the sales growing. We want the earnings to grow. What is the earning profit? Right? The profits determine the profit in that growth. It should grow every year. So this year, the company is earning 100. Next year, it will be 100. Next to that, maybe more than 5 crores. Like this, you want the earnings to grow as well. And after that, we also want is we want debt. Debt. It's not good. Too much debt is not good for the company. It is not good for individuals. If you get into debt, not be a big issue be to have a good life, be financially successful. Right? If the debt becomes unmanageable, it can take countries. Too much of a debt on a country also is not really a good thing. The debt is not good. Too much of debt assets is not good for the companies. It's good for the individuals. Definitely not good for the country. But we got to check the debt. And there are few ways by which we can check this, and this is called interest coverage ratio. For example, what interest coverage ratio really checks is it's called ICR, interest coverage ratio. Really simple concept, right? Now, let me know if you're able to understand this, okay? If you can't, let me know. So, interest coverage ratio, what it checks is how much is the business making, how much profit is it making, and how much is the interest rate. That if the company is earning 100 crores and the interest that it's paying is, let's say, 10 crores, right? So its interest coverage ratio is 10 crores. How? It's earning 100 crores and its interest payment is 10 crores. That means 100 divided by 10 because this is earning 100 crores. That's the profit. Interest payment is 10, so it can easily pay 10 times the interest charge, right? Now tell me, if there's a company that can easily pay 10 times, more than what the interest that it pays, do you think that company is, you know, doesn't have too much debt, manageable debt? Yes or no? Let me know where you're coming from. If a company is earning 100 crore and interest payment that it has to pay is like just 10 crores, just tell me yes or no. Can it easily pay this 10 crores out of this 100 crores? Yes or no? Do you think debt would ever be a challenge for a company like this? The answer is no, of course, it can easily be. It's like you are earning, for example, 1 lakh rupees a month, and you have house loan of 10,000 rupees. You can easily pay it, right? Because even after paying this, you still have 19,000 rupees less with you. It's not really something that will be adjusted. So debt is something that you need to want to see. Not too much of debt is preferred, right? And then we look at the internals of the company, right? We need to check what the management is doing, how the company managing internal, day-to-day activities, how the company is looking to earn more sales, more profit. All of this we check, right? Then comes we look at the competitions, right? The competitive advantage that the company has. I we check what is why is this company will be preferred by the customer. Right? So we practically be looking at this, so profit, revenue, earning, and then we look at the trend. What are the charts saying? Is it in a good trend, right? If you look at it, it is the framework that we follow in the Freedom Investors Hub. This is predict framework. Predict framework that we look at. So P stands for profit, R stands for revenue, E stands for earnings, D stands for debt. We check how much debt is there on the company balance sheet. I stands for internal, C stands for competitive advantage, and D stands for strength. So the predict framework is what we follow. And I'll just quickly show you how it works. Let's check out this company. So we're looking at trend chart, right? So let's check it out. So let's check out trend and see how it's moving. Trend. What we want to see is this company making money? And the answer is yes, it is, right? It was making money all throughout, and the profit was also growing. Then we had that COVID year, right? And it kind of went down in a bit. And then again, regained, and look at the base that's gone up, right? So typically, what we want to see is if the profit is growing, and in this case, definitely it's growing. You see that in the last 1 year, there's kind of stagnated, not actually part. The growth is missing. And maybe that's the reason why uh, stock market is very disappointed with the stock. The suddenly the growth, which was quite evident, the profit was growing. Look at this. There's the net profit. It was growing by good percentage points, and you can see that it went up by 10 times. It went up by almost 4 times here. And then it's dependent growth. And that's something that the market is not liking. Then it's a pretty framework that we want to be there. Yeah. The predict framework, the profit is there, but the growth, earning growth is missing. Is that something that's bothering the market? And that's why the price probably is coming down. But if you got it somewhere here, where you see a 10 time growth, and this happened in March 2023. So if you go back here and look at March 2023, this was that time, March 2023, when the profit went up by how much times? 10 times. If the profit of a company is growing by 10 times, of course, everyone would like this and everyone would buy this, right? The trend was also good. Yep. Let's go back here and look at couple of other things. And what we want is we want go back to the predict framework. We want the revenue to grow as well. And the revenue here, look at the company sales. See it growing. Let's start it growing from here. From 2,500 it went to 4,400 and then doubled. Sales doubled. And look at the profit. It went up by 10 times here. Right? And that's something which through the market to this stock, and you can see the kind of growth that we got. Right? So predict E stands for earning growth. Let's look at the debt here. Okay. So let's look at debt. You're talking about the interest coverage ratio. Interest coverage ratio is 15. That means it's earning 15 times more than the interest that it has to pay. So if it's earning, let's say 15, it just has to pay 1 rupee of debt. If it's earning 15 crores, it has to pay just 1 crore of interest. That means it can easily pay its debt, and that would never be a problem. So even debt is absolutely not a problem for a company like this. And then probably we look at go through some of the balance sheet and the annual report, which we probably will not do it here just for that all of you can get the grasp of it. And then we look at the trend. Okay. So let's look at the trend here. We get the trend, the dynamic line that we have in the middle. So when price goes above this dynamic lines, this is the time we can look at buy. Until the time the price is above it, you can look to hold it. And the moment it goes below it, that'll be the time for us to exit it. You can try it on some of the stocks. So if you want to see it on some of the stocks, right? Let me know. Let's have a look at this. Okay. So let's look at a couple of stocks that you want to see, and we'll have a look at it. Right. So let's just do this. Any stock that you guys have invested in? Yeah, let me know. We'll just check that out right now. And this would be for investment purposes, right? This would be for investment purposes. Yeah. Right? Yeah, Tata Steel, okay, Asian Paints, Adani Energy, okay, Asian Paints. Sure, we look at Asian Paints. Yes, sure. And let's look at a couple of stock. Tata Steel, we have a lot of Tata companies. Now, Tata Steel, there you go. Right, so it went above the dynamic line here at 111 and made a high of 180. That's an 80% return in about 6 months or only 1 year. Right? And here it went up by went above the dynamic line somewhere here. From 15, it went to 150. That's a 3 times return in a very short time. Let's look at Adani Power. See, power, there you go. So Adani Power went above in August, right? Did not really go much below it. It went above and remained above it. Still is trading above it. Prior to that, it went above the lines of So the idea here is if you can find out recent companies and along with that, look at the trend. And if the trend is right, you get into those companies, can be good with us. Can be somebody's talking about Asian Paints. Then look at Asian Paints. Now, Asian Paints is not really doing well, right? It went above the dynamic, it went below here. This was in 2017, and it went above it here. The price then was 1,000, and it made a high of around 35,000. So you can see about 5 years, it went up by 3.5 times, which is pretty good. In about 5 years, if it can grow by 3.5 times, which is almost 4x, what we want to achieve in 10 years, it has achieved that in about 4 years. And then it has been not going anywhere. Right now, the trend for it has been not to that. Yeah. Okay, so Adani Energy Solution. Let's look at that. So struggling, you can see that the moment it went below this, it kind of collapsed. Prior to that, it went above it here in December. This was somewhere around you can say around 400, and it made a high of around 4,000. That's a 10 times return in about 1 year or so. That is the power of investment. But it can only be a power if you have a system. You need to have an exit system, you need to have an exit system. And again, if you're new here, you don't need to bother about it too much. You can look to simply invest in mutual funds, and that be more than enough. You can invest in mutual fund, you can invest in ETFs, and that's like more than enough for you. Okay? I'm just taking it a little step further so that those who are looking to invest, they can look to learn some things by which you can analyze any time, right? And what are we looking at? We are looking at this range framework. It has about only profit income, where the revenue and the earnings profit is growing. Low debt company, right? If we look at the internals of the company, it should have that competitive advantage. And finally, we would be looking at the trend. The trend is right, it's going down, it's above the dynamic line and well to six. Yeah, so let's also look at Tata Motors. Let's look at Tata Motors. So what is Tata Motors doing right now? Look at this. It went below the dynamic line here and see what happened. It just kind of went down quite a bit. It went above the dynamic line somewhere here in November 2020. Price then was something around 180 and it went all the way till almost 1200. Right? So that is pretty good. We've seen a good bit of rise even here. And of course, when it's below the dynamic line, it's like keep wait, right? Because something like this can happen too, that can go down drastically, right? And then it kind of went higher from here and it made a good move from here. So now, how do you go about investing in direct stock? If you want to build a direct stock portfolio, how do you go about doing it? So this is what you can look to do. This is what you can look to do. Select about 5 to 6 sectors, right? 5 to 6 sectors. From each sector, select about 2 to 4 companies. And when you do this, you will end up building a portfolio of about 15 to 25 people. You will get select 5 to 6 sectors. It could be any sector that you like. It could be finance sector, it could be let's say consumption, it could be auto sector, it could be let's say EV sector nowadays, right? You can say it could be healthcare, it could be pharma sector, right? 5 6 sectors. Select 2 to 4 companies and 15 to 25 companies they will end up with, and that's how you can build your portfolio, right? Now, if you want to make it even more I do is I look at the 100 most profitable companies of India, right? So I look at 100 most profitable companies of India, right? And out of the 100 most profitable companies of India, this is what I do. I look at 5 to 6 sectors. Select on focus companies, some leaders, and I'm able to make a 15 to 20 companies that are going. Okay, this is for a very long term that are able to not today. Now let's show you what some of the companies have been able to do. So let's check this out. Here. So this is that list of
मम्मी खाना देना
IT companies, power companies, finance, IT, chemical, finance, insurance, auto components, so cement companies. So quite a lot of range of sectors we can see. And what we want to do is we want to invest in about 15 to 20 stock clusters this, right? Now, if you look at this, look at the last 6 months results, right? This is what some of these companies have been doing. Let's start this. Okay, let's see this. Let me start this thing. In the last 6 months, look at the kind of return these top 100 most profitable companies of India have been able to make. Look at this. So return, which is the macro, has given about 58% return in 6 months, right? We get, if you're doing fixed deposit, you probably get this kind of return in about 8 to 10 years.
हेलो घर पे बस खाना खाने जा रहा था दरिए पे हाँ चलते फिर हाँ हाँ ठीक है हाँ
1% penalty. Maybe let's say if you have some portfolio invested, you have like a couple of crores invested, or even if 1 crore invested, you're getting about 1% return a month. That means you're making probably 1 lakh a month. So there are about 67 companies that are 67% of these companies were able to deliver more than 6% capital. Let's double this. How many were able to give more than 12 10 kind of returns? Let's look at this. So more than 12, let's count this again. We have about 48 companies giving more than 12% kind of return. 48 out of 100 companies. That's almost 50% of this list. This is the list that I'm making. Yes. Some of you would want this list. This list of 100 most profitable companies of India. How many of you would like this? Type in me in the comment box and I'll give this to you. Type in me in the comment box. This is a list of 100 most profitable companies of India using all different sectors. The last month of return is the weighting series. Yeah. All those are typing in, I'm going to give this to you. Right? I'm going to give this list, a list to you. Right? So, as you can see that even without putting too much effort, all we are looking at is we are focusing on one thing that the business is in existence for. And what is that one thing? That one thing is this. All the profitability is what we're looking for. So these are 100 most profitable companies of India. If the companies are making money, do you think the demand for that company would be more or would it be less? What do you think? What the demand for that company which is making money and is growing? Would it be more or would it be less? Let me know in the comment box. Type in more if you think the demand will be more, or type in less if you think the demand will be less. Don't say things. When you type in, you can select everyone so that everyone sees. Okay. So, yeah, this is something that right you'll be able to get if you get a company which is making money, demand will be more for it. And if the demand is more, of course the price will go up because a lot of people will want to buy, and because of that buying pressure, the price will go up. So look at this good company and giving great returns. I'm saying that even let's say randomly, say like
नहीं वो तो देने को भी
we'll end up making good amount of profit, right? Let's look at the number one company of India, right? So look at this. The number one company of India right now is HDFC Bank, right? Now, if you were random about it, right, in the last 6 months, even if you were random, and you just randomly selected 15 top 15 companies, what kind of returns were you able to get? Look at this average of the returns of the last 6 months. But you would have made about 11% return. Randomly you invested. Let's say let's do it for all the right? Let's say if you did it in the next 15 companies, you got about 10% kind of a return. Yeah, no, if you did it another 15 companies, you got about 60%. That's pretty awesome, right? Let's say if you did it, let's say